If you take a look at the Federal Reserve data, the wealth gap has widened. Let me just pull this up, so I don't want to quote wrong numbers here, but the wealthiest 1% has seen look at this distribution of household wealth. If people want to Google this themselves, distribution of financial assets. So the top 0.1% now own $19.9 trillion worth of wealth. Now, the top 1% own $24.6 trillion of wealth. The bottom 50% own $3.6 trillion of wealth. The top 0.1% now own more wealth than the bottom 50% combined.
And so joining us now on Speak Up is a fan favorite and my favorite, David Lin. David is the founder and host of the David Lin Report. Welcome to Speak Up. David, let's start with your background a little bit in telecoms, energy, ETFs, etc. Tell us what the David Lin Report is for those of us that may not know you.
Thank you very much, Anthony. Big fan of your work. So I'm very humbled.
And the hair is absolutely fantastic. I have a little bit of hair jealousy. It's rare. It's rare for me to have hair jealousy, but I want you to know I'm expressing a little bit of hair jealousy today.
Well, look, I need hair gel to get up to your level, whereas you just look naturally good. So, some of us have to work hard. My background is the David Lin Report. For those of you who haven't seen my work, it's a channel dedicated to finance and economics, and that is my background. I started my career working in finance at a firm called BCA Research. Did macroeconomics research for 5 years. That was in Canada. Then I moved to another channel called Kitco. Did that for a couple years. Once I started to grow my own audience, I decided, well, let's do this on my own. I wanted to be an entrepreneur, work in media, eventually grow the brand into multi-sector company into financial products as well. But for now, it's just media. And I'm on YouTube. I currently have 160,000 subscribers, averaging between 2.5 million to 3 million views a month. And I focus on all asset classes. The goal is to educate the audience about finance, economics, and investing. Sort of the purpose of your show as well. I think we have a lot of similarities in the goal there.
Listen, you do a phenomenal job. You built an incredible following, and let's face it, they don't call me the mooch for no reason, Lynn. I'm trying to mooch off of your following. I'm hoping your fan base gravitates over here.
Oh, you're a very humble man, Anthony. For everything you've achieved, I don't think you need to be mooching off me.
No, mooching off David Lin and the David Lin Report. So tell the audience about the macro situation. Where are we right now in the macro economy?
This is I think the biggest theme, at least for me, is disinflation. I know there's a big debate out there as to whether or not we're going to get continued inflation, higher inflation, sticky inflation, or our prices going to stay where they are or come down, which is deflation. I think it's going to get disinflation, which is what basically that means for the audience watching. It's a lower rate of growth of inflation. It doesn't necessarily mean overall on an aggregate basis all prices will come down, but we're seeing that today. Just today I was looking at the news. Walgreens is announcing price cuts on 1,500 items. They were cutting, for example, they're cutting vitamin prices from about $13 to $11. This follows as last week Target, Amazon announced similar price cuts on their grocery items. Amazon, for example, cutting grocery items by up to 30% on their online stores and in their brick and mortar stores. So we're seeing big price cuts across the board at big box retailers. What does this mean? Well, it means other stores are likely going to follow. It means that these stores are losing purchasing power, and it likely means that they realize consumers aren't going to be spending their money unless they sacrifice a bit of their margins. So we can expect possibly a bit of EPS compression by the next quarter. I think disinflation is going to be a theme. The Fed hasn't seen that yet because these price cuts haven't been reflected in last month's CPI. A big component of the CPI, as you know, is energy, which has been strong. Owner's equivalent rent, which has also been strong. It's been coming down, but it's still relatively sticky upwards. And so the CPI on an aggregate basis is still pretty high, as you know, above 3%. But I think if you take away energy, if you take away some of the other essentials like rent, for example, healthcare. Healthcare is never going to come down. Tuition is never going to come down. If you take away those components, if you look at what people are actually buying on the ground, groceries, food, those things are going to come down. And why was CPI strong to begin with in the first place in the last couple of months? Well, we had things like auto insurance go up. We had things like home insurance go up. Those things aren't going to go up forever. So as the CPI relaxes a little bit, the Fed's going to have a little more leeway to cut rates further down the line. Macro shocks obviously could push this in the other direction. We've seen shipping rates go up earlier in the year as the Houthis attacked the Red Sea Canal. What does this mean for inflation? Well, it means regionally around Europe, inflation could see a shock if that goes up again. Actually, it did go up. If you was looking at the Financial Times, there was a chart showing shipping rates just spiking up randomly in the last couple of weeks for seemingly no reason at all. I don't think the Houthis were involved this time like they were earlier in the year. But look at what the ECB is doing, Anthony. The ECB just today, the head of the Finnish central bank announced that it's likely they're going to cut rates by June. That's coming up. And so if we get a big macro shock like something happening in the Middle East that could push up oil prices or could push up shipping lane rates, the ECB is about to make a big policy mistake. So disinflation is a big theme for me this year. We haven't seen a recession yet in the U.S., but layoffs are rising. The unemployment rate is now 3.9% in the U.S. And if we consider the possibility of further pricing power loss of these big box stores, then we're possibly seeing, next thing that's going to happen is bodies are going to roll. Layoffs are going to happen some more. That could put the economy into more of a slowdown.
So, I mean, all of this stuff I basically agree with. And one of the things I track, and I'm sure you track it or are aware of it, is something called Trueflation, Truflation. If you go to trueflation.com, it's a decentralized way to get inflation data from the overall market. And so what they do is they send out tremendous amounts of tags to people to report prices around the country, at the gas pump, in the food supply chain, if you will, the grocery stores, etc. Trueflation.com has two statistics. I want you to react to both of them.
Sure.
Statistic number one is the US dollar has lost 25.44% of its value since January of 2020. So the inflation that was inducted into the economy as a result of lax monetary policy and tremendous fiscal stimulus has cut U.S. purchasing power by 25%. It's also had effectively eliminated 25% of the U.S. debt, because that's what inflation does in terms of real terms. You still have the nominal debt out there, but you have that kind of inflation, you're wiping away a swath of it. I want you to react to that. And the second piece of data is I logged in this morning in preparation for our interview. U.S. inflation, government reported inflation is 3.4%, but Trueflation is saying it's only 2.6, which is consistent with what you're saying, is it's more real time, and they're probably picking up some of those big box grocery store price reductions that you're inferring. Their trend line is down. They expect this Trueflation number to go to 1.5% over the next 12 months. So, number one, I want you to comment on the loss of the dollar, the value of the dollar. What does it mean?
Yeah.
And then number two, if you were the Fed chair empowered with this data, what would you do?
Okay, let's answer number one first. Loss of purchasing power only affects the bottom 50%. What it basically means is that we have a widening wealth gap. What do I mean by that, Anthony? Well, what happens when we have inflation that's wiping out the purchasing power of your dollar? It means we also have asset price inflation. The stock markets, Bitcoin, as you know, cryptos went up a lot more than 25%. So the wealthy 50% of the population, well, it's really just the wealthy 10% who own assets, they're getting wealthier. Their net worth has increased by more than 25%. They can afford the loss of 25% down on their purchasing power. That doesn't mean much to them. Actually, this is backed up by real data. If you take a look at the Federal Reserve data, the wealth gap has widened. Let me just pull this up, so I don't want to quote wrong numbers here. But the wealthiest 1% has seen look at this distribution of household wealth. If people want to Google this themselves, distribution of financial assets. So the top 0.1% now own $19.9 trillion worth of wealth. The top 1% own $24.6 trillion of wealth. The bottom 50% own $3.6 trillion of wealth. The top 0.1% now own more wealth than the bottom 50% combined. That wealth gap was not this wide 10 years ago. So, with the loss of purchasing power from inflation comes the rise of assets that will make the wealth gap wider. That's the first thing that we have to be aware of, is that the loss of purchasing power doesn't affect all equally. And in fact, what comes as a result of that is actually more beneficial, I believe, to those in the top 1% who actually own financial assets. To your second point, what would I do if I were the Fed? Well, first of all, the Fed has a mandate to look at official data, not true inflation, not real-time data, not data by other agencies and organizations and economic economists. They have to look at their own data, and their own data is unfortunately lagging. So to answer your question, I wouldn't do anything because I can't look at that data to react to it. What I suspect may happen over the next couple months is that the CPI data released by the BLS will slowly catch up to what you're probably reporting right now, which is Trueflation. So would I react to this right now if I were Jerome Powell? No. Would I start reacting to it if the PCE, the core PCE, as reported by the BEA, starts coming down above below 2.5%? Possibly. But again, I still have a 2% mandate to reach, and that we're nowhere close yet by either headline CPI metrics or the core PCE metrics. So the answer to the question is, unfortunately, not much.
Okay. So, I mean, these is great commentary, and I think this is exactly the reason why people look at the Lin Report. People come to Wealthion to hear people like you, and this is, these are the concerns. Let me feather in more
Sure.
concerns and get you to react. We have a geopolitical situation. I sort of call it the unholy trinity of geopolitics. We have the Hamas, Israeli, Gaza situation. We have the Ukrainian war with the Russians, where it's spreading. I think you have to be honest about that. If Macron, the president of France, is suggesting that we're going to use Ukraine is going to use Western weapons and use those weapons on Russian soil, what does that mean for the war?
Mm-hmm.
And then the last piece of this, of course, is the military exercises in and around Taiwan and the flex going on from the mainland relative to the democracy in Taiwan. So I want you to react to those, and I want you to tell me what you think is going on in terms of the marketplace. How is it affecting the market?
Yeah, so I'm not a geopolitical expert. Just as a disclaimer, I think there's a lot of other people more qualified to analyze these issues in more depth than I am, including yourself, by the way, Anthony. But I will answer your question from somebody who observes the markets and somebody who's interested in how geopolitics affects the markets. Let's break down each of these components one by one. So Hamas, Israel. Well, the Hamas Israel war has kind of subsided. What we're concerned about right now is Iran Israel. Recent escalations have been, I would say, just posturing. It hasn't amounted to real damage on either side, and I don't think either side wants to escalate. What does Iran want? They want to maintain their current oil production at the current prices. Obviously they would do better if prices were higher, but higher prices would probably imply outright war, which they don't want. They don't want any disruption. They don't want the U.S. to be involved any more than there already is. So I think that for now, what we're likely going to see, and this is from my conversations with actual geopolitical scientists, we're unlikely going to see further escalation for now. On the issue of Ukraine and Russia, yes. So Russia has said that they're likely going to, or they're interested in testing tactical nukes on the battlefield. I mean, then again, Russia has had a history of using nuclear weapons as a scare tactic. It's part of their vocabulary. I wouldn't read too much into it. What is interesting, though, to me, is NATO conducting war games on the border of Russia, preparing for a possible invasion. I think that's just the West, again, posturing that they're not willing to step down either. So no immediate signs of a de-escalation and just yet. What I follow more because I'm born in Taiwan, is the Taiwan China crisis there, or not issue, not so much crisis. The new president was just sworn into office, Lai Ching-te. He is part of the party that wants independence. He's called for meetings with Xi Jinping several times. These meetings have been rebuffed. They have no interest in meeting with him. He has no interest in the president. The new president of Taiwan has no interest in reunification. So it's kind of a stalemate. Nothing's really changed. He's sort of just following the policies of his predecessor. So I wouldn't see his inauguration into office as an escalation of tensions. It's more just a continuation of the status quo. It'll be more interesting to see how the next president, either Biden or Trump, reacts to this. And I think that would probably be the bigger issue. Both presidents, or both Biden or Trump, would be a second-term president. As you know, that could actually mean that they could be more hawkish in their foreign policy stance, because neither of them are interested in a re-election. They are more concerned about actually getting things done, which means would probably take higher risks. So evaluation right now is that no de-escalation for now. But for me, at least, I'm not seeing any signs that the marketplace is really going to be worried about this just yet. Stocks are still hitting new all-time highs. The oil market is not pricing in any significant geopolitical shocks right now. It was earlier, but it's come down since. So I don't think the market is too concerned, and right now, neither am I.
Okay, I mean, very, very good summary. You're a Buffett and you're a Munger watcher. So tell me what we can learn from them. And when you talk about bulletproof investing, what could we do to make us bulletproof today?
Buffett and Munger. Okay. Yeah, I interview a lot of value investors. I've never had the chance to interview Buffett, and sadly, I'll never have the chance to interview Munger. But I spoke to a psychologist yesterday, and I just want to share a piece of what he told me. This is Robert Cialdini. I don't know if you read his book, Anthony.
Yeah, Psychology
Yeah,
Persuasion. Yep.
yeah, influence. And Munger actually, when he read the book in the 90s, told a Harvard commencement class that in a speech that everybody, I'm paraphrasing, but everybody should get a copy of Influence. Everybody needs to pass it on to their friends, family, children. Apparently, Munger was so impressed by this book, and apparently, according to Cialdini, who told me on the interview, it made Berkshire Hathaway so much money by chapter 2 or chapter 1 that Munger actually sent him one Class A share that Cialdini still holds today. And I asked him, what does Buffett do that perhaps other fund managers should learn from? He says every annual report, on the first page, first thing they do is list the mistakes they made the previous year. They said, these are the mistakes we made. Okay, we're going to learn from this mistake. We're never going to repeat this mistakes. And then importantly, he bridges that into the successes they've had in the previous year, the things they've done well. What does this do? This, according to Cialdini, allows people to gain trust. This is not a management team that is beyond his own ego. He doesn't have an ego. He's going to learn, and he's going to make everything better for shareholders. At least that's the image that this kind of messaging projects. They also use words like family, like, you're treating shareholders like a family member. It brings a sense of unity. It brings a sense of togetherness. Cialdini said he never sold that share because of that reason. Also because I'm pretty sure the share's done well, so that's probably another reason. But Buffett does a lot of things that he calls one of the pillars of persuasion is reciprocity. So what people do for him, he'll try to do for others. That's one of the pillars of persuasion that I think that has made Buffett very successful, at least according to Cialdini in his book. What else? What else do? Okay, stepping aside from the psychology aspect, what do we know about Buffett's investing style? One of the things that strikes out to me is that he doesn't buy things until he claims that he or his team fully understands it. For the longest time, as you know, he's missed out on Apple, right? And there was actually, I watched a CNBC interview a while ago where the reporter asked Buffett, why didn't you buy Apple? Do you regret not buying the stock? And he said, well, of course, looking back, I regret missing out on the gains, but, I don't regret being on a boat or captaining a boat I don't feel confident enough to be the captain enough. In other words, he didn't know the stock well enough to actually own it. And now, as you know, it's one of the largest holdings. So has he missed out on gains? Yes. But this approach to investing has limited his losses as well. I think so many people rush into things not fully understanding it. You see that in the crypto space a lot. You're an expert on the crypto space. A lot of people rushing into things they may not understand. And granted, it's a difficult space to understand, but I think if you actually just take the time to learn more about which project or asset you're buying, you may actually have a lower chance of realizing losses. That's something we can learn from Buffett. It's not just value investing, it's his approach to risk management that we can all learn from. And the value investing is self-explanatory. He buys things that he believes are cheap. And there's various approaches as to how you can evaluate an asset's valuations relative to its peers. But I would say what stands out to me is his reluctance to jump into something that's new and hot.
It was it's probably 20 years ago. I think you'll enjoy this story. I got a call from, so I used to have a relationship with my first RIA with Fidelity, and they had me in their advisor referral program. And there was an Asian gentleman living in a sort of one of those one-story ranch houses in Weston, Weston, Massachusetts. And I flew up. I took the shuttle up there. I drove to the guy's house. I went into his living room. It was a very modest home. And he said that he saw me on TV. He wanted to ask me for some help. I said, okay, great. What would you like me to do for you? And he said, well, give me a second. He went upstairs and he took out a statement that he had from Charles Schwab. And he had, and this is 20 years ago, he had a $500 million, and I'm going to repeat that. He had a $500 million position in Berkshire Hathaway. He had bought the position in 1968. It was 42 years later.
Yeah.
And he had a $500 million position. Now, if he had kept that position, it's $1.5 or almost $2 billion today. Man was in his 70s. He said, what should I do with this? And I looked at him and I said, nothing. You should do nothing with this. And that you should, the smartest thing you can do sometimes in life, David, I think you know this better than anybody, is nothing. The emotions and the whims that we carry with us in life in our primordial brains could knock us out of great investments. And so I wrote to Buffett in 1997. I used the Noom de Plom of my daughter, Amelia, who was 18 months old at the time. And I said, Mr. Buffett, I just bought a Class B share because we didn't have the money to buy a Class A share at that time, even though it wasn't really that much, 15 or so thousand. And I said, what advice do you have for me? I have a life expectancy of 84 years. I have 82 and a half years left, which I can hold your stock. Buffett wrote back. I have the letter framed in my office. Wow. He wrote back and said, I think your decision to own the stock for 82 and a half years is a manifestation of short-termism. My own intention is to hold this stock for 100 years. And I love telling people this because if you change your mindset about investing and you make it way longer term than other people think, you have a material advantage over them. And if you could take your ego and you can take your emotions out of things, you have a material advantage over them. Let's go to crypto for a second. You're a crypto enthusiast. What do you think? What's happening in the world of crypto?
I think governments are starting to, possibly for political reasons, possibly because for financial reasons, but starting to warm up to the notion of crypto. The ETF for ETH was just approved. Donald Trump himself just said that if he were president, he would ban CBDCs and he would not, I think what he said was he would, I'm paraphrasing here, but something about Elizabeth Warren's anti-crypto army and, stopping her as well. The Democrats are probably going to look up to this and say, well, look, we've got to catch up or we're going to lose the young votes too, to the Republicans. So I think it's going to be, maybe you disagree, but I think it's going to be a race to see who gets more of the crypto votes by November. And we're going to see more lax policies, more policies relaxing around regulations in the U.S. I think that's for me, the biggest development and biggest change that's going on in the marketplace right now. We know about the Bitcoin ETF that launched. By the way, Grayscale GBTC was just surpassed by the BlackRock IBIT in terms of size. So that, shift there. Um, what we're seeing also is the emergence of, well, I don't think this is necessarily new, but I think this is going to continue, the emergence of use cases in layer ones outside of traditional banking. We're looking at gaming as a big development. We're looking at tokenizing real world assets as a development that more people will start to use. And what I'm interested in, I don't think anyone's talking about this, at least not as much, is how AI and blockchain will be intertwined in the future. Imagine a world. I was just thinking about this last night. Imagine a world in which a robot hires another robot to perform a service. It's not entirely implausible that, let's say, I don't know, a robot needs some service and needs to be repaired and goes to a robot repair factory serviced by other robots. Well, if this is completely automated, how are they going to transact? How are they going to use any currency at all? Are they going
Right.
to credit themselves? Are they going to, well, it would make sense that they would probably use some sort of system whereby they can track it on a ledger. It's immutable, so the robot can't just change the code and do some funny business with the transaction. It's relatively decentralized so that they can operate amongst themselves, and it is relatively liquid. What did I just describe, Anthony? I, you know, a number of cryptos could fit that description.
Mhm.
So I think
Oh, no, it's
technology is
fascinating.
going to create,
So,
technology is creating
so,
new use cases.
so no one's ever answered this that I'm aware of, and if you're aware of somebody, help me out. What if a robot can experience pleasure, or a robot can experience more broadly feeling? Is that possible? Could that ever be possible? And if it is possible, what happens to the behavior of AI if that could come to pass?
I think we have to get a neuroscientist on the show to answer that better. But from what I understand, my limited knowledge of robotics and neuroscience is that feelings are just electrical signals passed on to the brain. Um, I suppose, in theory, that could be replicated. And
Okay, so that's my point. If that's what it is, I mean, I'm getting great pleasure out of this conversation, David. But there are
thanks.
other things in my life that give me even more pleasure, and I think you know where I'm going with that. What happens if the robot ends up like that? What happens to the society? See, I just think that we are so early on all this stuff. We don't really know where this stuff is going to go, and obviously, I accept Elon Musk's position that these machines will be way smarter than all of collective humanity over the next 10 years. I accept that. I'm just wondering if it adopts or adapts into something that we're not
I don't think
thinking about.
I don't think a robot needs to seek pleasure. I mean, think about what happens when we go out and seek pleasure. We have a dopamine rush. We feel good afterwards. We have chemical reactions that will trigger certain reactions in our body.
Mhm.
It's a psychological need to seek pleasure, to basically, for a lot of different reasons, for physiological reasons. The robot doesn't have a need for any of that.
Mhm. That's true. Well,
I don't.
just throwing that out there to get you
Yeah,
to think about it, my friend. Okay, so let's go to some audience questions. Okay, you've
yeah,
been generous with your time, and I want to keep plowing ahead if you don't mind.
sure.
How do you look at reliance on charting and technical frameworks for
Mm.
Bitcoin with the ETFs? Doesn't that change the dynamics of technical movements in price? And have you changed your technical analysis for Bitcoin based on that? This is Rich from Florida. So thank you, Rich from Florida. It's a good question.
Yeah, several parts of that question. Let's answer one part at a time. How do you look at the reliance at charting and technical frameworks for Bitcoin? Well, the reliance of charting and technical frameworks is the same for any asset class. So if you believe that charting and technical analysis works for stocks, then it should also work for Bitcoin. I'm not a technical analyst. I've interviewed several technical analysts. Um, I'll let their track record speak for themselves. I don't personally understand charting enough to use it for if I were investing in or trading. I would look more at news events, because I understand, again, going back to what we talked about with Buffett, I don't understand charting as much as I do understanding that Bitcoin reacts to demand shocks from the Bitcoin ETF. That makes sense to me. It also makes sense to me that there could be a Bitcoin shortage of mining production if demand for ETF continues to grow at this current pace. That makes sense to me. Looking at technical patterns and how the chart has behaved in the past doesn't. It's not something that I fully understand. I've actually interviewed Eugene Fama, who is a Nobel laureate in economics.
Sure.
And I asked him about technical analysis, and he called it rubbish. His partner, Kenneth French, no, not Kenneth French, Eugene Fama told the story. He said one time he was in a school, and he walked into he was telling a story about somebody else. He walked into a room, a faculty members at the school, and he said, "Okay, guys, I got this chart here of this price of some asset here, and it's based on these technical patterns. Where do you think the chart is going to go next?" And people had a bunch of answers, and they had a discussion. At the end of the discussion, he said, "Well, look, I just made that up. These are just randomly made up numbers, just to prove a point that none of you know what's going to happen based on past predictions or past results." So that's one side of the argument. Reliance on technical framework. I'll leave it up to the audience to decide. It works for some people, doesn't work for others. What with the ETFs, doesn't that change the dynamics of technical movements? No, it doesn't, because the ETF is not okay. Well, does it change the dynamics of the technical movements? You're adding in another layer of demand. It doesn't change the technicals at all. All it does is that you have more news to factor in. But if you're a pure technical analyst, you would make the argument that the price reflects all news to begin with. So it doesn't matter how many more layers of fundamentals you add in. The price is always reflective of those news, assuming we have a perfectly efficient market whereby the market absorbs all information. So no, it doesn't change the dynamics of that, because the price factors in the ETF news. What's the last part of the question? How have you changed your technical analysis of BTC based on that? I think I've answered that already in the first part, so no.
All right, good. Let's keep going. When we hear other countries or other central banks are buying more and more gold, and even the Fed this morning actually made a statement that they're recognizing that banks are replacing some of their dollar reserves with gold. What do they use for payment, and who do they buy it from?
Ooh.
This is Kevin from Minnesota, but I'll start. They're using U.S. dollar, and it's interesting because a lot of the Bitcoin maximalists feel that why wouldn't the Fed just print money, because they print money all the time, print $1 trillion and buy the Bitcoin network, or buy 2/3 of the Bitcoin network. But yes, they are using dollars.
Yeah.
And I guess the real question is, why do you think they're buying more gold, David?
I see. I didn't know they were using dollars, so thank you for clarifying that. Because in theory, they could use their own domestic currency to buy gold. I mean, no.
Yeah, it's hard. It's harder to do that, obviously, and market is more fickle on that. It's more of a dollar based, like oil, like crude oil. It's more denominated in dollars, because dollars is the reserve currency. But said differently, or asking sort of the tie-in question, why do you think the banks are buying more gold and forsaking dollars?
This is a question that I've asked several times on my show. I'm going to give you my answer, which is I don't know, but I will tell you what people have told me. Okay. One of the arguments for de-dollarization is simply just diversification. I think a lot of these banks, particularly China was one of the biggest buyers of gold in the last couple of years. The central bank, they've held too much treasuries. It's just a diversifying tactic, nothing more to it. The other de-dollarization aspect is, well, look what the U.S. did using the SWIFT system with Russia. We don't want to be on the long end of that. We don't want the dollar to be weaponized and potentially hurt us. We want to, diversify from that. So it's a geopolitical issue as well. And I think that the other aspect of central banks buying gold, take a look at who's been buying gold. It's mostly the Eastern central banks, right? So Middle East, Eastern Europe, China, I mentioned, India as well. Actually, the G7 countries haven't, to my knowledge, haven't added too much to the gold reserves. Canada has no gold. They've sold off all their gold in the 2000s. Bank of England's been selling gold. So anyway, it's mostly the Eastern central banks. They have probably a case to diversify away from the dollar and into their own trading block. I think they're holding reserves as a safety play. I think some of the central banks have been price sensitive. If you take a look when they've been buying gold, it was pre $2,000 an ounce. I'm not saying the central banks are the best hedge funds in the world, but they've had a history of buying low. So I think they probably. I've asked this before. I've asked a gold analyst, does the central bank buying of gold present a leading indicator for the gold price? They say no, but if you look at history, I mean, it's actually kind of yes. So I think those are kind of the reasons that have been presented to me. I haven't looked into any deeper than that myself.
Okay, let me ask you one last question here, and I want to switch over to my AI talk with you because I want
Sure.
to pick your brain.
Sure.
Give us a piece of investing. We always are asking people because our listeners are asking for it. What are actionable things that viewers and listeners could do in this marketplace? What looks valuable to you on a fundamental basis based on everything we're talking about?
I'm going to give a piece of advice that one of my investing profs when I was at McGill gave us. I know this is very generic, but I believe in it. Invest in things that you understand. This goes back to my Buffett discussion. Pick a stock of a company that you like. Doesn't matter if it's an Apple product or or a shoe product, or it doesn't matter, because 9 times out of 10 you are going to understand that stock better than your peers, and you will know when to buy. You will know what the company is doing, such that it could add or detract from shareholder value. You will be able to know when to get out, and you will be able to know whether or not to buy its competitors or its peers. Get it in an industry that you like to follow, because there's opportunities in every single industry right now. I mean, I can give you a macro framework as to why I think interest rates are going to fall. Perhaps the TLT, which is a 20-year ETF, which is trading at its multi-year low. It hasn't been this low since I think like 6 or 7 years ago. It's 50% off its top from 3 years ago. If that could be a good trade, I can give you, things that I think could be a good trade. I could probably tell you copper is overvalued. It just ran up to its all-time high last week. It's coming down. Short copper maybe in the short term, but these are just things that I'm gathering because of my own analysis. If you follow what I say, or anybody else for that matter on your show or my show, they could be wrong, right? Everyone, just do what you think you understand. Pick something that you like to follow, and just follow a few of those things. You don't need to. You don't. For retail investors, you don't need to buy 40 different stocks in your portfolio. Just have a few of them that you really understand. That's my advice.
All right, it's good advice, David. It is incredible for us to have you on Speak Up. I want to say thank you. And where can we find you before you go? We know about the David Lin Report. Well, where else are you? Where are you on social media? Where else can we find you?
I'm on all the socials. So at David Lin _TV on Twitter, Instagram, TikTok are just short form videos. But yeah, YouTube is my primary platform for now. I'll have a newsletter coming out soon on my website, thedavidlinreport.com. But YouTube, you can find me there at the David Lin Report. Just look it up. It's there.
All right, my friend. Thank you. Really great to have you on.
Thank you very much, Anthony. Appreciate your time.
If you like this video, then you'll like this video as well. Check it out.